Michael, it's good to, quote, see you from a Farr. See what I did there? We've got this infrastructure bill. That's roads and bridges. That's a lot of spending. Social spending bill there as well. Whatever one thinks politically of these things, forget that. Will $1 trillion of just kind of invented new made-up money going into the markets for the 10 years just continue to propel us to new records, or is inflation just going to tear the whole thing down?
Good morning, Brian, in London and from early here in the United States. Yeah, I think you're on right. You framed it properly. We've got more money going in. We've got an inflation problem. We've got markets making new highs. And by the way, the markets are still a little less expensive than they were a year ago on a price to earnings basis. But we're shoving more money into this market. There's a lot of liquidity in the system. The consumer has a lot of money. I think you're going to see one of the best holiday spending shopping seasons in years. Consumers have cash. So prices moving higher. Everything now, in my opinion, depends on what the Fed does. Will they hold back too long? I fear that they will. I fear they're not being aggressive enough. But even with this taper, that's still another $500 billion, $600 billion that they're going to continue to buy. So they continue to buy that. You get another trillion. It won't all come in the same year. And infrastructure, more cash into the system clearly increases that demand, and that puts more pressure on inflation, which puts more pressure on the Fed.
Yeah. Okay. So there's so much to unpack there, Michael, by the way. So we have got, and listen, infrastructure, the roads are terrible, the bridges are terrible, New Jersey Transit's terrible, Amtrak is terrible. We look forward to fixing all of these things. But you're going to be doing it in a market where you're going to be buying commodities at record highs for the next 3, 5, 10 years. So we're going to be paying a lot more for copper, steel, all that stuff. I get it, but it does go to the inflation story. We've got a 10-year yield under 1.5% again. The market doesn't seem to care about inflation now, will it?
Yeah, I think, Brian, it will. And that 10-year yield, I was talking to other folks, some of the halftime report investment committee gang last week. We were all kind of puzzled with if inflation and if the Fed's tapering and if we've got all of this going on, why is that 10-year yield 147? It's a bit of a head scratcher, but the bond market's message is they're not as sanguine about a rosy future for the market, or certainly for the bonds and interest rates, as we go over the next couple of months, particularly the growth. So we've got this big supply chain issue, and we've got more purchasing. We've got the supply chain with prices going higher. Does that end at some point? Is capitalism solve that problem so that we get back to, what, 2.5% GDP growth? If you look at growth of number of employed plus productivity, you get back to 2.5% GDP growth.
Very quickly, Scott Miner at Guggenheim told me at Milken, we were doing a panel at the Milken conference, that he didn't think that interest rates would go above 2% forever. You agree? Quickly.
No, I don't agree. I think we get above 3% on that 10-year. It could be a year, but I think clearly out there, yeah. But I think GDP for 2022, still a strong number, 5 or 6%.